Welcome back to a new video, guys. Today we're going to talk about two interesting candlestick patterns that can help us understand when the battle between buyers and sellers may be changing. They are called the Bull Counterattack and the Bear Counterattack. These patterns are especially interesting because they show us how the opposing side can suddenly step in and fight back. So let's understand both patterns with real chart examples. We have two types: Bull Counterattack, Bear Counterattack. Let's start with the bullish version. Bull Counterattack. What is a bull counterattack? A bull counterattack generally appears after a downtrend. The market has been moving lower and sellers are in control. We then get a strong bearish candle. But on the next candle, buyers suddenly step in. The second candle opens lower, but buyers push price back up and the candle closes near the previous candle's closing level. This is called a bull counterattack. The important message here is sellers were in control, but buyers fought back aggressively. Let's look at the chart. Here we can see that price has been moving down. Sellers are clearly controlling the market. Then we get a strong bearish candle. But on the following candle, buyers step in. Price initially opens lower, but buyers push the market back up. The candle closes near the previous bearish candle's close. This tells us that sellers were no longer able to maintain the same level of control. After the counterattack, price may find support around this zone. If sellers fail to break that support and buyers continue stepping in, the market may start moving higher. Bear counterattack. Now let's look at the opposite pattern. The bear counterattack generally appears after an uptrend. Here, buyers have been in control. Price continues moving higher and eventually reaches an important area. Then we see a strong bullish candle. But on the next candle, sellers suddenly step in. The second candle opens significantly higher, but sellers push price back down. The candle closes near the previous bullish candle's closing level. This is the bear counterattack. The message is buyers were in control, but sellers fought back aggressively. Look at this chart. Price has been moving higher, creating a clear uptrend. Then we get a stronger bullish candle. The next candle opens higher. At this point, it may look like buyers are going to continue pushing price higher. But then sellers enter aggressively. Price moves back down and closes near the previous bullish candle's close. That's our bear counterattack. After the counterattack, price may find resistance around this zone. If buyers fail to break that resistance and sellers continue to step in, we may see a bearish reversal. Don't look for these patterns everywhere on the chart. The trend and location matter. A bull counterattack is more meaningful after a clear decline and around an important support or demand zone. A bear counterattack is more meaningful after a clear advance and around an important resistance or supply zone. If you find the same pattern randomly in the middle of a range, its significance can be much lower. So don't just ask, what candle pattern is this? Ask, where did this pattern appear? That's where the real information comes from. So guys, that's the bull counterattack and bear counterattack pattern. If you found this video useful, make sure to like the video and subscribe to SKB Trading Lab for more trading education. And remember, our rule: plan, wait, confirm, execute. I'll see you in the next video.